the marketplace. And today we're going to be looking at Cardinalstone's mid-year 2024 economic outlook. We are in the second half of the year, and it's time to, should I say, take stock and look at what's come and what is to come in the year 2024. And joining us this evening on the show is Olaolu Boboye. He is the head of macroeconomic research at Cardinalstone. Very good evening to you, Olaolu. Great to have you on the marketplace.
Good evening, and thank you for having me. I'm excited to be here.
It's an absolute pleasure to have you. For all our wonderful listeners out there, you can be a part of the marketplace by sending your messages in to us on WhatsApp 0809 440 981 0809 440 981. Any thoughts, any questions you might have as well? Hey, we'd love to hear from you. You can also join us on YouTube as we're streaming live. You can catch us at Smooth 981 FM Lagos on YouTube. Okay, so getting into the nitty-gritty of the conversation, now the Nigerian economy is front and center in a news report from Cardinalstone Partners. Now, the report is titled "At the Precipice of a Strategic Shift." Now, Olaolu, what we need, first of all, is for you to summarize this report for us. Is the report basically saying that pay attention to global and domestic trends regularly and readjust your portfolio accordingly, or is it something else?
Okay, once again, thank you for having me. The first focus of this report is on the people, how they've been impacted over the last few years by the policy of the government, because we felt that we need to take a different approach to how we analyze the economy, especially the domestic economy, because we think social impact is very pronounced, and hence we make our report centered around social factors. So focused first is on the people. Then secondly, we think that the global dynamics is changing, right? There are two major schools of thought for the global dynamics. Some believe that the global economy is out of the woods and we expect soft landing going forward. After all these rate hikes that we've seen from the developed markets, that is leaning towards the view by the IMF. Some are taking on that position that, we're likely to have the possibility of a recession in the US. A recession in the US could connote a weaker growth for the entire global narrative. So if you're having a weaker growth across the globe, it will affect how you position across different asset classes, compared to when you have a soft landing narrative. So clearly, it impacts the people and it impacts portfolios.
Okay. Since you're saying it's going to impact people and portfolios, I know that the report also points that there's a wide output gap of 3%. Can you speak to what the biggest contributor to this is?
Okay, so actually, average growth over the last few years has averaged, over the last 3 years, for example, has averaged around 3%. However, we at Cardinalstone believe that growth potential should be higher than that. We should be seeing the Nigerian economy growing way in excess of 3%, maybe 5%, 6%, right? And we try to look at what could have contributed to this widened gap. Number one, we think labor productivity has been weakened over the last few years. To put a bit of context to this, in the last 3 years, Nigerians have exited this country like never before. And most of the people exiting are largely skilled laborers. So a very practical example, we have shortage of doctors today in Nigeria, because if you compare the pay of an average doctor here in Nigeria to an average doctor out there abroad, it is wide, right? So doctors are leaving. We now have to have asthmatic students and non-consultants to attend to people like consultants in some hospitals. If you go to some schools, for example, we have NYSC guys serving as teachers. Some people, secondary school students, are acting as primary school teachers in some states. All this is because of lack of adequate skilled laborers in recent years because of the Japa syndrome, right? Aside from that, because when we're looking at the goods potential, we looked at it from a Cobb-Douglas production function, which focuses on labor and capital productivity. Okay. When you move over to capital, when you try to look at what businesses are doing, it's not shocking that because of the excessive rate hike, because of the rate hike that we've seen from the CBN businesses have been badly beaten. We've had some businesses, left the country. We've had business confidence weakening, especially sectors that are very sensitive to interest rate changes. Sectors like manufacturing, right? They've been affected. We've also had business profitability weakening. If you check the data as of Q4, as of 2023, business profitability slumped to the lowest level on record, worse than COVID, worse than 2027 and 2017 and 2016, 2017 recession. And as of Q1, the CIT, that is revenue generated from company income tax, moderated on quarter, which also have an impact on business finance, on the government finances. So clearly, it's been a mix of multiple things. So that's why I would think that, there is a gap, beyond this 3% that we are doing, that we're celebrating, we could actually go beyond that.
Okay. Hopefully, we will actually live up to that and go beyond 3%. And I'm going to, sort of pedal back to what you mentioned, Olaolu, about the Jacques syndrome and people leaving the country in droves, an exodus of biblical proportions, if I could say so myself. And one of the main reasons that happens is because these people are looking for a better life, better remuneration for the skills they have to offer, and so on and so forth, which then leads me to the minimum wage. Now, your report estimates that 80,000 naira will be agreed upon, which will cost the government about 1.5 trillion naira. Now, some have worried about the inflation risk, but you say it's not, that it may not materialize. How come?
Okay, so before I go to the impact of inflation, impact of minimum wage on inflation, it's good to put it out there that this minimum wage is absolutely needful, because, like I said, it's about the people, right? You drive on the street of Lagos, on the street of Nigeria. If you are blessed a bit to have a bit of small car, dress well, you are at risk, because the closest people out there to you are literally suffering. And if you are not careful, you are the closest person to be attacked, right? So increasing the minimum wage is not a luxury. Some states are already doing 70%, and we see no reason why the government should not approve even over 80%. Even though some states have clamored that, they don't have the capacity to pay. That's why we went for a conservative 80%, 80,000 naira, not 80%, 80,000 naira levels. Now, assessing the impact on inflation, what we did was to draw an assessment impact over the last 12 years to see what has been the correlation between wages and inflation. Now, what we saw was that the correlation was given about 0.28, which means for every 1% changes in inflation in minimum wage, the pass-through to inflation is just about 0.2. That's about 28%, which is not very significant, right? And the reason is not far-fetched. If you increase PMS prices today, the impact is sharp and continuous, because every time I go to buy, it will be expensive. But if I increase wages, right, there might be a sharp impact at that time. People will, wages high, we need to push up price. But then it becomes a normal sense that, it is not a case of too much money pushing fewer goods. It's actually few money helping people to live above poverty line. Let's just be able to eat, to wear clothes, and then to get housing. So because of that, that money is going for essentials. It's not for luxury. It's not to spend around. It's not to, to just be, spending anyhow. So clearly, the pass-through to inflation is not very significant.
Well, that significance is actually something that we need to talk about, especially from your report that actually estimates 92 million Nigerians living below the poverty line from 70 million in 2016. And we know that businesses, when it comes to profitability, has slumped to a historic low. Now, I know that you have a list of firms that have also exited Nigeria for various reasons, which we're not going to get into. But I want to know, per capita GDP is also falling. How do we make sense of all this, and how does it also affect Nigeria as well?
So again, it depends on the side of the divide that you are.
Okay.
People that understand the data, that understand the story, and people that don't, right? Now,
So break it down for us.
Yes, exactly. That's why we try to make that report people-centric, so that they can know that, hey, the government is trying to put in policies in place. And these policies, for everywhere such policies are implemented, they come with short-term pains. Now, these short-term pains, it depends on how quick the government is able to react, or how quick the policies are able to acclimatize. Then the impact will start waning. Now, you've removed subsidies, which is still there. Electricity subsidy is still there. Exchange rates has gone up. Automatically, the impact is very significant. So minimum wage coming on board to cushion this impact is a social safety net, which you cannot discard. So clearly, it's good. I think that Nigerians have bear the pains enough, right, over the last 1 year. It's time for them to start seeing the benefits of the efforts of what the government has done, right? So per capita is going down at the moment. Business profitability is going down. But then there's also a better part to it, which is now understanding the data. Now, inflation is expected to come down. If we see a sustained pattern in what we are seeing now, into next year, inflation will come down, which means that people go into the market and then things are expensive, it becomes cheaper. I'll give you a very practical example. If you go to the market about 4 months ago and you want to buy a basket of tomatoes, you must have a minimum of 140,000 naira to buy it.
Very true.
If you go as of last week, you'll be spending less than 100,000 to get it.
Yes.
Now, we are not where we used to be as of last year, but there's an improvement, right? We think that once this cascade into all products and prices are coming down, or prices are increasing at a slower pace, it helps to ease the burden on the people. So quite a lot of people don't understand the numbers, because what they see is, I go to the market and I'm seeing
what it translates to from buying things in the market. Yes.
How do I survive? So clearly, I feel like understanding this data that, hey, there's a bit of short-term pain now. We expect it to improve in the medium term, basically.
All right.
Teething pains, which will lead to relief at the end of the day. That is what we are looking at. And we'll continue the conversation looking at Cardinalstone's mid-year 2024 economic outlook with our guest, Olaolu. We'll come back in and talk more about this on the other side of this quick breather right here on the Marketplace on Smooth 98.1. Stay with us.
Don't go anywhere. When you spoke about the tomatoes, yes, that's actually said can actually see the effect.
Yes.
Because before, even the smallest batch of tomatoes, you get it at a ridiculous price. But even as at today, you could get some for 10,000 naira, which you couldn't naturally. If you see what was being touted for 10,000, you would literally cry about 4. You're right, 4 months ago, but
4 months ago, exactly.
So it's actually a better thing that we're seeing right now. But there's still some things that are still a bit iffy when it comes to foodstuffs. Beans seem to be on the horizon for getting any lower. And I wonder,
which one is that? Which product is that?
Beans.
So I think that, see, there was something that happened in H1, which quite a number of analysts didn't capture. So because of our FX movement, Nigeria's food prices became very cheap. Nigerian food prices became very cheap for neighboring countries.
Go ahead, please.
Okay, Nigerian food became very cheap for neighboring countries. So quite a number of them were buying Nigerian agro products
and exporting them.
No, I mean, they were coming to buy. So people were exporting to them, because you make money from there. You sell, they are competing with domestic prices. So if I offer it in domestic market at 1,000 naira, and people are willing to buy it at 1,003, after taking my logistic costs, I'm making an extra 300. I'd rather sell to them. That was one of the things that drove competition for farm produce. And we don't have enough. We still have to depend on, So that was why those prices skyrocketed. But of late, exchange rate has somewhat stabilized, right?
That's the
So
last
it
conversation.
so it will have a bit of impact, basically.
All right, welcome to the second half of the marketplace right here on the Smooth Drive on Smooth 98.1. Love music, love life, 34 minutes past 5 p.m. Joy and Ayo in the studio, as well as our very special guest in the person of Olaolu Boboye. He's the head of macroeconomic research at Cardinalstone, and we're looking at Cardinalstone's mid-year 2024 economic outlook. You can be a part of the show, as always, by sending your thoughts in on WhatsApp 0809 440 981 0809 440 981. That is the WhatsApp number. So if you've experienced anything that you'd love us to know, or you'd also just have any questions for Olaolu, he'll do his best to answer them as we're looking at the mid-year economic outlook. Where have we come from and where are we right now? Also, where are we going? Very important questions that need to be answered. All right, Olaolu, welcome back to the show. Let's get back into the conversation. Now, the presidency announced a 2 trillion naira stimulus last week for a number of sectors. Now, there's no word on how it will be funded. Now, where do you think that this money comes from? I know I would love to know, and a whole lot of people would also love to know this as well.
Okay. Why the presidency is yet to tell us how they intend to fund what they want to do, right? From what we gathered, it's a public-private partnership, right? And if you look at the composition of that presidential committee, that presidential council, the likes of Dangote, Otedola, Brismark, they're all private sector guys. We think that part of the money will most likely come from the private sector. We have pension fund administrator sitting on a lot of cash. They can be mandated or asked to invest in such a fund. Aside from that, government can come to the public, to the capital market to borrow money. But I think they will tilt towards more of the private, because if you come to the capital market, interest rates are high. You are trying to ease fiscal pressure on the government books. You don't want to add an additional 2 trillion around that. So I think it's come mostly from the private sector.
Okay. Now that we're even talking about, debt and all that, or I want to actually talk about Nigeria's debt, right? I know that you've also done an informative chart on the debt situation in your report. However, the agencies that review debt in Nigeria says that we have a stable outlook. Do you actually agree with this, or do you think that there's some aspect that needs some more introspection on it?
So before we jump into why they were able to draw that conclusion, it's good we take it systematically. First, Nigeria's debt in the last 1 year has jumped by over 100%. Now, it's worrisome. People seeing the numbers, who are just seeing the headline numbers, say, hey, we've jumped by more than 100% in the last 1 year. We are in problem. We are likely to find ourselves in Ghana's situation in the next few years down the line. It's good to put explanations to this. More than 65% of that movement that we've seen in the last 1 year is driven by currency devaluation. So currency devalued, currency depreciated, depending on the word you want to use, over the last 1 year. That depreciation propped up external debts being recorded in domestic currency. That was the first thing. Secondly, is the securitization of the ways and means. So the government was owing the CBN over 30 trillion, about 30.1 trillion, as of last year. But they were able to securitize a material portion of that. They initially securitized 22.7. Then they also repaid back about 7 trillion to the CBN in the H1 of this year. That also prop up the debt numbers. Now, looking at the debt sustainability of the country as of now, there are a few metrics that we can use. And the worst thing to do is to debate with numbers. What are the numbers saying, right? We have debt to GDP. Debt to GDP at the moment is around 46% levels. It's way lower than 55% that has been set by IMF for countries like Nigeria. If you take other metrics like export to GDP, external debt to GDP, external debt to export, Nigeria is fine. If you look at short-term debt to external reserve, IMF mandated that it must be 100%. Nigeria is way below that. We are around 55% to 60%, which is fine.
Mm-hmm.
Then, if you now look at what forms the view of sustainability, if you do an average of Nigeria's debt at the moment, everything, you'll be getting an average of 13 years, which means for Nigeria has a large composition of its debt in long-term instruments, which means worry of default or debt distress between now and the next 10 years is out of place, right? So those rating agencies picked all these factors together, tied them into a single report, and the fact that the government is even making efforts to stimulate tax earnings, rebase the GDP, which will likely support, tax metrics, fiscal metrics, and debt metrics. They tied all this together to say, hey, Nigeria's debt is going up, but we still think it's sustainable. So that was how they arrived at the sustainability or a relatively stable outlook for the country.
All right.
Thank you for that explanation, Olaolu. Now, talk to us about why you see year-on-year inflation peaking and what that means for Nigeria's monetary policy path.
Okay, so we think that inflation will moderate in the second half of the year. And there are two major factors or reasons for that. One, Dangote Refinery has been selling AGO lower than what it was in the market prior to now. So in April, Dangote sold in Lagos here. I will use Lagos as the market, but in other places was a bit higher. Sold in Lagos for 1,000 naira. Then at a point, it sold less than 1,000 naira.
Okay, AGO, that is diesel.
That's diesel, exactly. The benefit of diesel has a far more reaching impact on inflation and on the people than even maybe PMS, that's petrol. And this is why most or even all agricultural machineries are powered by diesel.
Sure.
Trucks for moving agricultural products, machineries, they are powered by diesel. Higher diesel prices translate into higher input costs for farmers, which translates into higher food prices and higher food inflation. So AGO prices coming down has a positive pass-through to transport, has a positive pass-through to food, and has a positive pass-through to energy, which has a positive pass-through to core inflation. So when you tie this chain together, you'll see that just AGO prices moderating from 1,000 levels in Lagos, maybe around 1,002 to about 1,000, had a very significant impact on inflation. Second factor that will drive inflation lower is base effect. Now, base effect does not necessarily mean that prices are coming down. What it just means is that because inflation is you do change, you do change, percentage change on the CPI index, which is the consumer price index. Because we are coming from a very high base as of last year, when you do the change this year, it will mean lower inflation. So technically, these two factors will drive inflation lower. But the most significant impact will stem from AGO prices, energy prices being lower, because it's lowering the month-on-month numbers, which is the most important reflection of inflation and not year-on-year numbers. So these two factors will combine together to drive inflation lower. However, it's good to mention that there's also another positive pass-through coming from currency. Currency has been relatively stable. We think that there's a bit of leg room for more stability till the end of the year. But there might be a bit of volatility maybe in August and in September when people like my presenter start demanding for FX to go for vacation, with their family. But Naira will most likely be a bit stable in the second half of the year, which also have a pass-through to inflation. But there might be some upside risks, especially if we see PMS scarcity. It's already happening in Abuja, and we are hearing some of it in Lagos. But we don't think that that is significant enough to max the moderation in inflation that we're expecting.
All right, Lalu, thank you for that. And talking about the vacation, let me say less. Let me say less. The time is absolutely run by, but I need to squeeze this in and just talk briefly about stocks. And according to a report for fixed income, it says go long and go big. What exactly does that mean?
Okay, so in the last 1 year, because interest rate environment is going up, what people do is that they buy short-term instruments. That's instruments with 1 year or less than 1 year maturities. Because in a rising interest rate environment, it's better to buy those instruments. Because a 1% change in interest rates, we have a smaller impact on short-term instruments compared to long-term instruments. So if you go and put money in long-term instruments during rising interest rate environments, you're likely to lose money. Now we think that interest rate has peaked because our expectation for inflation is to come down. Exchange rate is relatively stable. We think that on the maximum, the CBN will do about 100 basis points to 50 to 100 basis points rate hike in the second half of the year. If they do, compared to the 750 that we saw in the first half of the year, if they follow that pattern, it means that long-term instruments will become attractive. Now, some people will argue that, but when I went to the bank is offering me treasury bill for about 23%, 24%. It's higher than what bond is giving me of about 20%. So if you buy those treasury bills now, you're likely to face reinvestment risks because we don't think that interest rates will stay elevated forever. Our own in-house expectation is come second half of 2025, the CBN will cut interest rates. If they do, it means that if you buy NT bills now, you're likely to face reinvestment risks next year. So if you buy NT bills now and it matures this time next year and you want to reinvest, where do you put the money? Bond yield might have gone down. NTB yields might have gone down, which means that you might not get those high interest rates. But at 21%, if you lock in your bond now, even after removing taxes, maybe you still have about 20% for yourself. So if you buy a bond, giving you net interest of 20%, and maybe you bought a 10-year bond, that means over the next 10 years, you'll be getting 20% compared to what would you have gotten maybe from next year.
Okay.
All right. Thank you for that crash course into the stock market and, of course, explaining to us what that portion of the report actually meant. Thank you so much, Olaolu Boboye, the head of macroeconomic research at Cardinalstone. It's been a pleasure having you on the marketplace with us this Monday evening.
Thank you so much for having me. It's always a good time being
here. Absolute pleasure. And to all our wonderful listeners, thank you for being a part of the marketplace. We do this every Monday at 5:15 p.m. on the Smooth Drive right here on Smooth 98.1. Well, stick around. The Smooth Drive will kick on and, of course, more great music as we journey along on a Monday evening.